All right, we'd like to welcome everyone to the January 12th meeting of the Oklahoma City Post-Employment Benefits Trust. First item that we have on the agenda is the approval of the minutes from November 10th, 2014. All in favor? Any opposed? All right, the next is to receive the monthly investment flash report from November 30th, 2014 and December 31st. Doug Anderson's here with Gregory W.
Good morning, Mr. Chairman and trustees. If you will take a look at the November report, I thought we would cover that one first, just sequentially. If you look at the November 2014 market performance, you can see that for the last month, equities were positive on the domestic side for the most part. Looking back over the last year, the Dow Jones Industrial Average up 13.4, the S&P 500 up 16.9. As we go down that, you see that large caps are beating small caps. Domestic shares are outperforming international by very wide margins. And as we go over to the fixed income side, positive returns on fixed income, but especially for long treasuries, as that is a safety asset, and we're seeing lower interest rates over the course of 2014 and so far this year, which is not something many people expected. As a matter of fact, the year 2014 was one of the most difficult years for active managers or investment decision makers, because we saw what was strong at the beginning of the year. Energy was extremely weak at the end of the year. You saw sectors such as healthcare outperforming the rest of the market, which is not something that most people foresaw, and the second leading sector would have been something like consumer defensive, which is one of the most defensive sectors of the market, or utilities, which in a potentially rising interest rate environment are not something you would expect to perform well. When we look at the market performance through this period, 20% of the return generated on the S&P 500, 20% of that 16.9%, so almost 4% of that return came from 5 companies. Your Apples, your Johnson & Johnsons, your Berkshire Hathaway. So the market was very narrowly focused. And we saw this big switch from small caps to large caps, domestic outperforming international. But again, the most striking thing that we see on this page is the long-term Treasury index on the right-hand side, the BC long Treasury, up 19.2%. And it was such an unpredictable year that when we go back to the Bloomberg survey of Wall Street economists, there's 67 of them polled at the beginning of the year. Which way will interest rates go during the year? All 67 of them said that they would go higher, and interest rates went at the long end of the curve almost 1% lower. So a very unusual year. If you look to the following page on the preliminary performance review for November 30th, you can see we really do have a tale of two cities here. The fixed income portfolio is working extremely well. We'll talk a bit more about one of the allocations in a moment, but you'll see Loomis Sales Bond, which is a core fixed income portfolio over the past year, was up 6.9% versus 5.3%. Double line bond, which over the same period up slightly less, and that's versus a benchmark return of 5.3%. Loomis Sales High Income, which is the high yield allocation, which we've not yet funded. We'll talk about that in a moment. Its returns were up 8.1%. But if you look at the benchmarks, the Barclays Capital, the core index was up 5.3%, while the high yield index was up only 4.6%, starting to see some risk aversion in these parts of the market. And then you'll see Hoisington, our active duration manager, the manager who invests only in treasuries, only very short-term treasuries or very long-term treasuries, and you can see that up 4.4 over the last 3 months, over the past year, up almost 25%, and they've done even better so far this year. We talked with Hoisington about their outlooks on the market, going into the employment figures that were released last week, which were actually weaker than expected on some measures, but also stronger on others. They still don't expect the U.S. economy to reach escape velocity, to start putting up 3-4% real GDP growth, but continue to bump along the bottom. And they say that they think in long-term interest rates, which are now at between 2.5 and 2.6, their expectation is they could get as low as 2%, given the weakness in foreign markets, the weakness in oil prices, and lack of inflation and employment growth in the United States. So that's the fixed income portfolio. As we go down, we see some results on the equity side, which are not what we had hoped for. The Dreyfus appreciation, which is our low risk, our very low risk, low volatility, large cap growth manager, up 12.2 over the last year. You can see the array of benchmarks we show below, and still they don't look great versus those benchmarks, but this again is a unique portfolio that invests in globally diversified, very large cap companies that tend not to have extreme movements in share prices, definitely not as extreme as the market. Looking back over the long term, you can see that this international exposure has cost them, as the international markets, if you go down to Causeway's results, the domestic market's up between 16.2 and 16.9 for the trailing year. For the international indexes, flat, and roughly 16% of this portfolio is in non-U.S. companies. Going down to the Delafield portfolio, this has had a very difficult year, and we recommend looking for a replacement for Delafield. As you see that they invest in distressed companies, which had a very tough time this year. Their three largest sectors are energy, materials, and industrials, which were not favored by the market. They don't own technology, which did well. They don't own healthcare, which did well during the period too. And Stevens, also some difficult times during the year. When we look back over the full year of 2014, 86% of managers underperformed their benchmarks. We attribute that to the frequent changes in market leadership, the changes in sector leadership, which happened at an unprecedented rate during the year, and also the increased usage of ETFs by large investors, which move share prices around less than logically sometimes. You are not alone when you're looking at your managers underperforming their benchmarks by wide margins. Like I said, 86% of managers did underperform. And do recall that the managers that we focused on here are very unlike their benchmarks by design. That being said, Delafield's results are very, very poor, and we think that there could be good alternatives out there. Causeway, our international equity manager, down slightly for the year, but looking at the out years, their performance is very good. And looking at the total fund results, very much dragged down by the Dreyfus Appreciation Fund. Positive returns for all periods longer than 1 year. And again, fixed income is working well, but the equity environment has been extremely challenging for active managers. Would you like to go to the December 31 update, and then we can discuss these? So when we're looking at the December results for the market performance, you can see that the domestic to international divide has grown even wider over this period of time. You're seeing the S&P 500 cap weighted up 13.7%, but the world ex-US down 4.3%. And if we remember all the things that we've seen in the international markets over the year, Ukraine, Russia, Saudi Arabia cutting oil prices versus the rest of OPEC, something that I just brought to mind this morning, Ebola, which was something that dominated the market for a 3-week period, which we haven't heard anything of since then. So it was a very topsy-turvy market. Being an equity investor was positive. Being an active equity manager, again, very, very difficult. Looking over at fixed income returns, the U.S. aggregate, which is the core part of the market, up 6%. The long Treasury market up 25.1%, again, defying the expectation of all 67 Bloomberg survey economists for the year, as interest rates moved sharply lower because there is no growth in employment in the United States, or no wage growth in the United States, and Europe and Japan appear to be going back into recessionary conditions. Going on to the following page, you can see performance. The picture has not changed dramatically. Delafield's still struggling. We're seeing some improvement from Stevens. Again, this is a difficult market. They're not investing in the highest of the high tech. Their portfolio is divided into two pieces, one of more stable growers and then another part of catalyst-driven and catalyst-driven companies, which tend to be single product, high growth companies that are debuting new products on the marketplace. As we look at the International exposure, negative for the year, and this is a rare occasion that Causeway underperformed. But you can see, again, in the out years, performance is good. Same issues on the Dreyfus Appreciation Fund. Stable, low beta returns across the board, which is something that this fund was designed to do and put in place. And our fixed income portfolio is all doing extremely well. Happy to take any questions. Total market value of $29 million, which is dramatic growth.
All right, are there any questions? Now, you said that you had a recommendation on, that you were going to be making a recommendation on Delafield.
Yes, we'd like to bring new candidates. We don't have a recommendation today,
Okay.
recommended fund, but we would like to review a few and bring a recommendation to next meeting.
And at the last meeting, we had discussions about the Dreyfus Appreciation Fund and the
Yes.
benchmarks. And the benchmarks, you've added more benchmarks that we're looking at on that one.
Absolutely. And you'll see that this is a unique portfolio, and it doesn't really lend itself to great benchmark comparisons. So what we have shown here is the S&P 500. We've shown the Russell 1000, which are the 1,000 largest companies. Not a great fit there. The S&P 100, which is the 100 largest companies in the United States. So you can see that their results track a little bit closer to the benchmark, but the one thing that none of these contain is non-U.S. companies, which Dreyfus will invest up to 20% of their portfolio in companies based outside of the United States. And when you look at the results of, say, the MSCI EFA, down 4.9% versus the other domestic indexes, you can tell that that's going to be a real challenge. Now, it could easily go the other way when international markets outperform. But I think that what we're trying to accomplish with Dreyfus Appreciation is stable exposure to very large companies with growth in and outside of the United States at low risk. It's the largest part of our portfolio. And it fits very nicely with a mid-cap value and a small-cap growth. So we're trying to have growth on the large cap, value on the mid-cap, and then growth again on the small cap so that the portfolio is fairly well balanced for the growth value cycle.
So we had Dreyfus on watch, though, right?
Yes.
And your recommendation was to keep them on watch at this point?
Yes.
And then the Delafield, had we had them on watch before?
This, I believe that we have, but this
Okay.
performance, when you look at it, a change needs to happen here.
Okay.
I have a question on Dreyfus in terms of the down capture. I know on the up capture we're not going to get as much because of the type of funding. But what does it look like on down capture?
In the latest environment, it doesn't look great, and it's atypical for them. They do have a fairly significant exposure to energy, which in the fourth quarter, as we all know, was one of the most difficult places to invest. But one of the nice things about energy is it has very high cash flows, and it does pay dividends, which makes them look at it as attractive. They're a low turnover manager. They're, out of the 65 companies in their portfolio, I think 15 have been in the portfolio for 10 years. 4 of them have been in for 20 years. So the turnover doesn't happen as far as a new name coming in or going out of the portfolio. It doesn't happen. They typically do buy on weakness. So when energy, the sector is repricing as it has been, they're typically watching very carefully and then buying on weakness.
Is it possible for us to where the service provided, and it doesn't have to be a recommendation, just get information for all of the funds that we have information pertaining to the up capture down
Sure.
over a period of time?
Yes, yes. One thing that I will say about Dreyfus is that when you look at their long-term results, they're very consistent versus their peers. I think that they outperform something like 87% of other large-cap blend managers over a rolling 10-year period. So it does require some patience. They do have soft periods of performance, but if we're looking at this as a long-term investment, which is what we like to do, they have outperformed 87% of their peers. We've been through this kind of soft patch with them before. And with low turnover managers, sometimes it happens, but they're not chasing the market. They're effectively buying on weakness and letting the market come to them. I think, go ahead.
So when you talk about a soft patch, what period of time are you typically looking at? If
Well,
something that's
Sure.
you're willing to endure as they're not performing maybe as well as some of their peers. Is there a time period that you watch on that, or?
We look at the portfolio and we look at the market conditions. The last 3 years have been pretty good for equities and pretty good for aggressive equities. So it's one of these periods where I'm not evading the question. It's an indeterminate period because it's the down and the up that they tend to perform better. I mean, when you look at Dreyfus, they've got 3-4% turnover in their portfolio. So you really want to take a look at the longer term, so the 10 years. Now, if as a board you're uncomfortable with that, we can certainly move a different direction, but we feel confident that...
But you're not seeing anything in change in management or anything like that,
No.
just indicating any kind of change in direction otherwise?
Now, the biggest change that we've seen in FIAS, which is the sub-advisor, was they bought Apple, was it 5 years ago? Yeah, they bought Apple 5 years ago, and that was sort of a departure from the consumer durables and the energies and some of the other companies. But they recognized that Apple had come of age as a global brand that was self-sustaining. That's why they bought it. So as far as organizational changes, issues, no.
Are all of our managers active managers? Are they all?
Yes, they are. They're very active managers.
Would there be any benefit to looking at passive managers, those that track the?
I mean, even like a mixture.
Yeah.
It's possible, absolutely. I look at these numbers and they make me a little bit uncomfortable. You see the diversion or the dispersion between the benchmark and the manager. We believe in active management long-term. However, sometimes short-term it can sort of buffer some of this discomfort or stomach upset like that might be happening. We would say that if you're going to have passive management, no fixed income. Fixed income is not a market for passive investing. When I look at this, possibly on the large cap side.
That's what I was thinking, is maybe we could consider looking at some passive managers along with our active managers.
It's definitely something that many of our clients have made that decision. Say, active management is great over the long term, but sometimes we want part of the, but in difficult times, especially like 2014, it's nice just to be able to say this part of the market, this part of the portfolio tracked. The rest of it, maybe it underperformed, maybe it outperformed. We understand why, but at least we have this part that's tracking.
Yeah, and I guess looking to it, even going back, if you look at the bottom on our total fund, how we're comparing to the policy index overall and the allocation index overall, that you see us tracking over the last 5 years, that's another thing I think for us to look at is of concern of how we've fallen below the the policy index and the allocation index, and sometimes at significant levels.
Yes. Well, I think back over the history that we've worked with this board. We started working with you really during the hardest part of the downturn. And so we've had a defensive mindset. And when you have markets, when you have equities over the last 3 years, compounding at 20% per year, the defensive mindset and the managers that we selected is going to restrain some of that.
And we selected that just because of the newness of the trust and the fact that we have such a small amount of equity.
Yeah, and our impression very early on was let's not take any big risks with the portfolio. This is new, the worst thing we can do.
So I don't mean that as a criticism. I mean that as looking at it, just saying are there things that we could do to help us to be, to look more like the policy, like the indexes.
Absolutely. Yeah.
But I also think that if we could get the information about the funds, the up capture and down capture, that would help us in determining whether or not we want to add some passive managers to the portfolio. It would certainly help us in times like this, that if we were tracking the indexes, at least we're not significantly underperforming if we had those passive managers.
It's such an unusual year when you look at it.
Yeah.
It's very unusual. The strong performers from last year, the strong performers the first quarter, second quarter, third quarter, fourth, it switched so dramatically that if you're a long-term investor, it's hard to capture that consistently. And you could be right 2 of the quarters or even 3 of the quarters and just have one where you're off, and the whole year can look disappointing.
Do you think our fund is large enough to add a passive manager in addition to our active managers?
Yes, I do. I mean, there's a large allocation to the large cap, again, part of that defensive mentality.
So that passive manager to the large cap. I
I would recommend that we consider it at some point in the very near future. So.
Why don't we bring, in addition to the upside-downside capture, why don't we bring some portfolio designs with the passive management, just so we can take a look at what has been versus what, it's a made-up portfolio. It won't be significantly different than what we're showing here, but at least we could show, during this period of time, the market was very volatile. This one would have done better than this one.
think that would be great.
And I think, we may have a discussion, too, about the forum that, would we rather do that as an investment committee, and do it more like a workshop setting, or try to do it just in a regular meeting, and so we can have discussions about that, of how we want to do that.
Excellent.
Okay. Thank you.
Thank you.
So the next item, I guess we need to take action on these. So we need to receive the monthly investment flash reports for November 30th and for December 31st. Can I get a motion? All in favor? Any opposed? Next item we have is Doug is going to speak to us about our high-yield fixed income and the recommendations that we had previously and the difficulties we had in implementing that.
Correct. Thank you. So this item should be in your packet. If you recall that early or mid-year last year, we discussed fixed income in depth, and part of that was to add a high-yield fixed income manager. These are junk bonds, effectively, below investment grade, reasonable allocation to them. They pay much higher yields than core fixed income, roughly double right now. And it gives you some access to higher performance during good times. We went through the entire search process, and the manager that was selected, if you go to page 3, would be the Loomis Sales High Yield Fund. Now, there was we had a lot of trouble implementing this decision. This is an institutional grade portfolio, which means only institutions are allowed to invest in it, and the entire account funding process went on for a long time, and then the documentary requests from the manager for the account sign-up process included providing some rather personal information from some of the board members, Social Security numbers, et cetera. That's not something that we're extremely comfortable with. So what we're coming back with is, here are the funds that we talked about. Loomis Sales is a great manager. They manage part of the core portfolio, and they've done very well in high yield. Now, this fund, the high yield fund, has several different share classes. It has an institutional share class. A lot of these sign-up protocols that they have instituted recently have been put in place so folks won't invest in it for 3 weeks and then pull their money out, because it's very difficult for high-yield managers to accommodate that type of cash flow. It also has to do with some additional regulations, federal securities regulations that have come in place since the great financial crisis. But really, it amounted to a big headache to getting into this fund, one that wasn't really necessary in our eyes. So if you look at page 3, you can see returns here for 3 funds: the Aberdeen Global High Yield, which is a high-yield fund that invests about half the assets in the U.S., about half the assets outside of the U.S. Loomis Sales High Yield, which was the original fund that was selected. And then we have Lord Abbett High Yield, which was not selected, but has also put up really, really nice returns. If we look at these on a risk-return standpoint, Loomis Sales is the most volatile of the 3 funds. It invests more in sort of quasi-equity, preferred stocks, convertibles, et cetera. But it has had excellent results over the long term. Aberdeen has the risk of investing in non-U.S. bonds, including emerging market sovereign bonds and non-U.S. based corporate high-yield debt. And you can see that strategy has really hurt them over the last 3 months and over the last year. And then looking at Lord Abbett High Yield, this is a portfolio that we have worked with for quite some time. It is the lowest risk of the 3. It is the most benchmark sensitive, I guess you would say, and the most attentive to managing its tracking risk versus the benchmark. Our quick recommendation is to abandon the Loomis Sales high yield portfolio, given that they are also the manager of the core portfolio. The documentary requirements of the institutional fund are, in our eyes, excessive, and there is a great alternative out there with the Lord Abbett High Yield Fund.
Okay. So do we need to get that in the form of a recommendation? Do we need to make a recommendation and approve that today?
There's a separate action on the agenda for that after this, so you can at that point in time. It's number 5.
Oh, okay, I got you. Okay.
I think just for the record, we should probably talk about the fees of these funds because it's always important in
Okay.
our eyes. And if we go to, looking for it, it's page 7. The pages in between there are various performance and portfolio characteristic comparisons, including upside and downside capture. But on page 7, you can see the expense ratio. If we were to go to the non-institutional grade fund for Loomis Sales, its fee is 90 basis points per year. Lord Abbett is 75% or 75 basis points, and Aberdeen the same. So this is a lower cost alternative to the non-institutional Loomis Sales fund.
Are there any questions? All right. So do we want to make a recommendation on this one? Does anyone have a motion?
I'll move that we go with the recommendation. Go Lord Abbett.
With Lord Abbott. So I got a motion to recommend the allocation of Lord Abbott. Do I have a second? All right. All in favor? Aye. Any opposed? All right. So we'll take that as a recommendation then.
Thank you.
Thank you. And that was actually under item 5, right, that we did that. The next item is acceptance of the financial report. And actually, Mitchell had made a presentation on this back in August, was it you said, Mitchell? And that there wasn't any significant change from what was presented at that time. We'd be happy to answer any questions that we have, but this is just the final audited report. We did receive a clean audit on the financials, and so we'd be happy to address any questions. I think the growth in our net position is very positive for us, which is a combination both of our investment earnings as well as contributing more than the cost of the plan above the pay-as-you-go cost, and so that was positive. But I'd take any questions if you have any. If not, I would take a motion to accept the financial report, the annual financial report for June 30, 2014. All in favor? Any opposed? All right, thank you. Next item is ratifying claims listings. All in favor? Any opposed? And the last item we have are any reports and comments from the trustees, the staff, or other interested parties. Does anyone have any other comments or anything that we need to report? All right, with that, we are adjourned.